sheet called growth calculations. Here I have two templates to calculate growth rates. One of them is, suppose you want to know what's the year one growth rate is going to be, or you want to predict. You can calculate the sustainable growth rate, whatever the dividend payout ratio of the firm, enter the return on assets for last year or, trailing 12 months, enter your target leverage or projected leverage. Again, the light greens are inputs. That gives you a sustainable growth rate. Alternatively, you may have estimates of growth using maybe some analyst projections. Let's say, in fact, in this case, this company happens to be Microsoft. Okay. The dividends in trailing 12 months is $2.91 per share. Estimated current year growth rate is 1431. I am putting terminal growth after 5 years as 5%, and I did not pick that 5% willy-nilly. Uh, Expected average inflation probably is about 2.5%, and the long-term growth rate of the economy is about 2.5%. So terminal growth rate that I'm putting in is 5%. It's the growth rate of the economy. And this is projected growth rate or growth rate expected by analysts next year. These growth rates for years 2, 3, 4, and 5 are calculated using a essentially linear projection. I'm basically saying next year this company is expected to grow 14%. After 5 years, it's going to grow at 5%. And the drop from 14 to 5 is going to happen in a linear fashion. Given these projections and given that we have an estimate of dividends per share, uh, they can automatically calculate projected dividends using the so-called H model. Now, I have these here. I calculated these using a formula, but if you want to, you could actually enter your own numbers. I'm going to go back here, and currently this little cell with the checkbox, if it is green, that means you have green light to enter the dividends manually. If you double click on this cell, that green check is going to be a red cross, and the projected dividends you have in the growth calculation page are going to be copied here. Double click, we copy them all here. Now I want to go back to solar mode. Of course, I want my unknown to be, in this case, market value. So let me see. I do need to change this back to 5%. I could have copied it from the other page, but I want that thing to be variable. And for Microsoft, let's assume 9.5% is a reasonable discount rate. We'll talk about that in future chapters. For now, just take it as gospel. So these projections basically say Microsoft should be worth $86. Now, Microsoft is trading around $400. So what I'm going to do is I'm going to change the unknown to terminal growth. Right now, these two are equal, so GoSig doesn't do anything. Now my market value becomes an input. Enter $400. This model basically says, or if we are to believe uh, the growth projections over the next 5 years, and if we are to believe that dividend growth model is a Good way to value a company. The current price of Microsoft implies a terminal growth rate of 8.64%. That's way above. Remember, terminal growth rate is until infinity. That is way above the average growth rate of the economy. So if you believe 8.64 is just too much, the company is overvalued. Otherwise, it's undervalued. For example, let's do something like that for NVIDIA. NVIDIA doesn't pay much dividends. I'm going to go to financeyahoo.com. Let's go to statistics. Let me see. Actually, let's go to summary first. And my computer's internet is too slow today. Come on, summary, where are you? Okay, it's only 4 cents a quarter. That means that's 16 cents a quarter for dividend. So it's almost zero, but actually, let's use another company that actually pays dividends, serious dividends. Let's do Pepsi. Pepsi has a dividend yield of 361, uh, which means this is the quarterly dividend. If you make the calculation, actually, I can do it from the dividend yield. Uh, what is the price? Yeah, I expect the dividend. Uh, the dividend yield is 5.20, or dividends are 5.22. Let's enter that here. $5.22. And let's find out what analysts think growth opportunities for Pepsi. Analysis. Growth estimate current year 216, next year 670. As you can see, these are below expectations for S&P 500. That is not terribly surprising because S&P 500 is rather dominated by firms like Nvidia, Apple, and so on. Let's see, 216 and 670. I'm going to leave the terminal growth at 5. And these are the projected dividends. Let's go to dividend growth model. To copy them, let's go back to manual dividends and enter back what you want to call uh, the auto dividends. Let's change the value to 144.58. Since I kind of screwed this up, let's enter a number like this. Okay. Now, in this case, the growth rate that justifies Pepsi's price is 5.61%. Of course, that assumes that Pepsi's proper growth discount rate for Pepsi is 9.5. Let's quickly do a quick and dirty numbers. If I go to statistics, come on, work with me. Yeah, my internet connection is somewhat slow. Let's do it again. Okay. It has a beta of 0.54, if you remember from your earlier classes. I'm going to assume a 10-year T-bill rate of 5%, so and a market risk premium of 6%. So 6, come on, not 9, 6 times 0.54 plus 5. Okay, 10 and a half maybe. That sounded kind of high, but hey, we'll just do an exercise. Okay, now this says for the current price of Pepsi to be justified, the terminal growth rate needs to be 676. That sounds a little bit high. Let's look at the same number for Coke, same numbers. Because Coke is going to have a similar beta, so I'm not going to worry about it too much. And let's find out the dividend for Coke current. 63.84 times 0.00306. So let's just say 195. Let's look at the analyst growth projections for Coke. $606 and 343. So those are the implied projections for what you want to call dividends. Before carrying them, let me make this red light first. All right. Now let's enter the price of Coke, 63.84. Pepsi and Coke have almost the same risk, so I'm going to leave the required rate of return the same. And given this, let's go to solar mode back again. This implies the 7.70. So in a sense, if we are to believe these dividend projections, which come from the growth projections, Coke is actually more expensive than Pepsi because Pepsi required a growth rate of around 6.5, and what you want to call Coke requires 7.70. In that sense, you know, Coke is more expensive than Pepsi, so a possible trade idea would be buy Coke, buy Pepsi, and short Coke. So in that sense, this is rather useful. On later applications, we're gonna kind of adapt this template into both residual income model and discounted cash flow valuation because in its structure, both of those models rely on some sort of projections over a few years, then assuming some sort of terminal growth. Well, mathematically speaking, they're identical problems. As we would call it in topology, they're homeomorphic, which means structure is the same. So converting this into templates for residual income model and discounted cash flow valuation is not going to be that difficult. And when the time comes, I'm going to give it to you guys. And I will see you guys soon.